Hey, Gabfocus. Welcome to 2024's very first episode. Melissa, how are you this year?
Doing fantastic. Fantastic. And I think this is a great episode to kick this crazy year off with.
What a fun way to start the year. I mean, one, the topic I think is a very much top of mind for everyone in the audience, from managers to owners to investors, but also the person himself, John Chang.
Exactly.
Welcome to the stage.
Hey, thanks everyone. It's great to be here, Tommy, Melissa. It's good times. We had so much fun last year. Looking forward to this.
This may just end up being an annual thing. Go ahead and bookmark your calendar for 2025. But y'all, in addition to this being the first of the episode of the year, this is our fourth season of Gabfocus,
Oh my
which
God.
is actually kind of bonkers. So thank you. I've some of y'all's names. I've seen you here since the very first episode. Some of y'all I recognize from Gab Fest, our very first virtual conference. So Melissa and I are more than thankful that get to do this. This is kind of fun. So today's expert introduction's not really necessary, but John Chang, tell us who you are with, and how long you've been in self-storage.
Name's John Chang. I run research for Marcus & Millichap, which is a commercial real estate brokerage company. As a company, we do a ton of self-storage brokerage. We help investors buy and sell properties. My research team is focused on providing insights on what's happening with the economy, what's happening in the industry, performance-wise, what's happening with prices and cap rates and yields to help investors make better decisions. Personally, I've been doing this, for a long time, since the late 90s, actually. I started with Marcus & Millichap. So doing this a long time, really focusing in on storage. You know, the sector itself has become a bigger and bigger part of the commercial real estate industry as a whole over the course of the last 10 years or so. So that's really when my attention started focusing on this property type.
So you've seen some cycles in our industry.
Oh yeah.
Yeah. So so we're excited to leverage some of that expertise. And like we said right before the show, you're here to solve all of our problems this year and look at the magic 8 ball. Uh, but as y'all know, Gap Focus brought to you by our teams here in East Tennessee, Knoxville, and Chattanooga. It's Plug and Lighthouse Storage Solutions. Gap Focus set up this way. If this is your first show, welcome. You chose a really good one to start your journey with us. Okay, Melissa and I will take turns asking all the questions, and our expert John will answer all of those questions. Of course, we have our pre-submitted questions. You can submit live using the live Zoom Q&A, and of course, we love it when we see the comment section on fire. But if you do have a real question, though, post it in the Q&A, because that's where Melissa and I can make sure that your question gets asked. So here's today's agenda. We're going to dive into the state of the industry. So what's the economic temperature check? I think we can't talk about self-storage without talking about the economy. So we're going to talk about where we are now. 2023 was a lot different than the 2 or 3 years prior. We'll talk about how we should approach this year. We're going to talk about what's there to look forward to. And of course, we'll end with our question of the week. So without further ado, John, Melissa, are we ready?
Let's do this.
Ready to
Let's
go.
do it. Melissa, start us off.
All right. So, temperature check. Let's kind of see where we were in 2023. So, what significant economic storage trends did you see emerge last year?
Well, the economy last year was bumpy, right? We had all the inflation, we had what the Fed was doing, and there was a lot of uncertainty. Quite frankly, if you look at the beginning of last year, everybody was saying we were going to be in a recession by now. And so really, honestly, it was a very dim outlook going into 2023. And the consensus estimates started in 2023. They were basically saying, economic growth would be like 0.5% at best. And by the time we got to the end, we actually just got fourth quarter GDP numbers this morning. The fourth quarter came in at 3.3%. For the year, it came in at 2.5%. And if you look back historically, that's a pretty solid number. There was no recession. In fact, third quarter had almost 5% economic growth. We've seen jobs coming in. We've seen a lot of momentum all through 2023. Everything was slowing down. It was tapering. We saw a lot of the economic indexes coming down over the course of the year, but they all were positive. And that's exactly what the Federal Reserve has been looking for. They were hitting the brakes. They were trying to slow things down and trying to get the economy to slow down so that inflation would go down. They pretty much achieved that over the course of 2023, but we're averting a recession, at least so far. And that was a kind of an ideal solution. Nobody thought we could do this soft landing thing, but it looks like that's what's in the cards at this point. And so it's really just a big kind of a slowdown year, right? Coming off of some really great growth in 21, 22, coming out of the pandemic. We slowed things down, and now we're going into what could be a very interesting 2024.
Wow. I mean, honestly, in my subconscious, I haven't thought of the R word, the recession word, in a long time. Right? Like I feel like that was everything that everyone was talking about Q1, Q2 of last year. And then by the time summer rolled around, like the podcast, the talking heads, the recession word kind of just disappeared from our collective vocabulary.
Yeah, we're not out of the woods yet. Last week we just did a webcast, and that is still available. You go to marcusmillichap.com, you can log in and find that webcast, register for it. But we had a webcast with Mark Zandi, the chief economist from Moody's, last week. He is still saying 25% chance of a recession in 2024. I checked Capital Economics, which is another fantastic economics resource. They're still posting a 25% likelihood of a recession in 2024. So it's still out there, but the soft landing is really the most likely scenario. They're giving it 50-60% likelihood of a soft landing in 2024. And so the risk factors are certainly going way down. I think that whole recession thing started when Chairman Powell of the Federal Reserve was at Jackson Hole, and he came out in, I think it was August of 2022, and said, "Everyone, there will be pain." Scared the crap out of everyone. And really, that's when everybody's forecast for 2023 went in the hole. All the predictions of recession started showing up. People were really bracing for that, and it never showed up.
Oh, thank goodness.
Yeah.
And like you said, we're not going out of the weeds, but for the audience, for resources, I did put a link to Capital Economics. Shout out to them, and then I put a link to the webcast that John mentioned with Zandi on there. So I think that's both of those are great bookmarks to bookmark. So I mean, along the trend of 2023 here, while we're there, like what surprised you the most about it?
I'm surprised it did so well. Honestly, there were so many predictions of negative predictions, but not only that, we had a lot of dysfunction in Congress. We had a war start in Ukraine, and we had a banking crisis in 2023. We had some climate change issues and hurricanes. I mean, there were a lot of setbacks over the course of last year that it's surprising that we didn't go into a recession, but consumption was so strong. People were spending money. You look at inflation adjusted retail sales by the end of 2023, they were up 3% compared to the prior year. And that's inflation adjusted. That's not a number you see out there all the time, but 3% inflation adjusted growth in retail sales. And we had job creation. We were adding jobs throughout the entire year. I think we added about 2.8 million jobs in 2023. And so you look at all of these things. We had a lot of strikes too. That was another major risk factor in 2023. So there are a lot of things there were a lot of headwinds, and despite that, we still maintained growth. And actually, I found that to be a little surprising. It was there were a lot of things that could have gone wrong, and they didn't.
Yeah,
Wow.
especially with all the doom and gloom that was being shouted from the rooftops. So, yeah, I'm glad you were surprised, John.
But
Pleasantly surprised. I'm really
the,
glad.
the doom and gloom is always out there,
Mhm.
right? I mean, I was reading a book about how to maintain a positive attitude, and chapter 1 it says first thing you do is stop watching national news, because it's they're being paid to put you in a bad mood and cause you to have a bad outlook. Now, unfortunately for me, part of my job is to watch the news every day, but generally speaking, when you see it, it's all bad news. And so if you focus on the numbers, they've been really good. But when you watch the national news and what's going on there, it seems like everything's about the things that are going wrong. So anyway, there's my advice to anyone who wants to have a really positive outlook in 2024. Stop watching national news.
But be sure you watch John, because
Yeah,
we need to
that's
hear.
not news. That's information.
That's facts.
Exactly, exactly. I like it. So, which of the current economic trends are affecting our industry the most today?
You know, of course, the one metric that I have found that has the strongest correlation to storage demand is household formation. And I found one of the key leading indicators to household formation is consumer sentiment. So, consumer sentiment asks people, how do you feel about where things are today? Now, that's different from consumer confidence, which says, how do you think things are going to be going in the future? So a little different.
Mm-hmm.
So consumer sentiment, when Powell came out and said, hey, there's going to be pain, and there was all those recession forecasts, consumer sentiment just tanked. It fell. It hit a record low in the middle of 2022 and going into 2023. It was a slow recovery process, and as a result, the household formation dropped, and we saw vacancy rates in apartments start to rise. We saw home prices were elevated. There was a slowdown in home sales, and so all of those trends work against household formation. And when household formation is down, then net absorption of storage space drops as well. Now, the good news is we just saw a big jump in consumer sentiment in the report that came out last week. That bodes well for household formation in 2024. And that suggests that demand for storage could be back on the rise. We are seeing it when you look at data on a quarter-to-quarter basis. We are seeing an uptick in that absorption level, but it's still pretty low compared to what it had been. So I'm hopeful, and it's looking promising that 2024 will be a better year for storage demand than what we saw in 2023.
Awesome. So, given that, how would you rate the health of the industry going into 24?
Overall, it's in very good health, right? So, vacancy rates are higher than they were prior to, in 21, 22. We've seen that upward pressure on vacancies, and we are predicting that they're going to continue to rise a little bit. There's still a lot of construction. Absorption is still trending upwards. So the second half of the year is going to be better than the first half, but at least according to the people in the chat, January was pretty good. So it could be better than we're expecting. But overall, we are still expecting those vacancy rates to trend upward this year. The construction pace is still pretty significant. We're looking at 2.5% inventory growth expected in 2024. And so we have to watch out for that construction and see how it impacts the property types.
Okay.
I think the watching the, how do you say, the what you talked about there, John. I think watching the what's going to happen with the housing stuff, right? As interest rate maybe falls as more people buy. And I think you mentioned some of there's new supply, right? I mean, Melissa and I live in East Tennessee, and we've had quite a few new neighbors in the last,
Yeah.
John, I mean, you're in Arizona. I mean, it's the same thing, right? And
Yeah.
and so I think Arizona and Tennessee are in the top 10 of new transplants in the last 2 or 3 years. And I don't know if Arizona is bigger has been more than Tennessee, but either way, we're in the top 10 for both of our states. And so we have a lot of new neighbors. And I think big part of that is going to come with some of the, I don't say crises, but a lot of the issue has just been there's no supply, there's no houses on the market, there's not enough new houses being built, and I think a lot of that is going to be caught up here, hopefully this year and next. So I think you're right. I think that all plays to how our industry will look. Some tailwinds for us, hopefully.
Yeah.
So let's talk about where we are now. I think that was a really great dialogue on where we are economically, but let's talk about self-storage specifically, right? So talk to me about street rates. Where are street rates looking in January 2024 compared to same period last year? And maybe if you can go back a little bit of ways too, John. So where are we with street rates now?
Well, you kind of have to look at it in context, right? So if you rewind the clock back to pre-pandemic, street rates are, I think on average nationally they're around a buck 15 a foot, give or take. And then as we went into the pandemic, we were facing an overdevelopment cycle until the pandemic hit, and then we saw demand surge and we saw rates climb up and push up into the buck 30, buck 35 range, depending on the market and the property, the facility, and so on. We saw those vacancy rates drop. Over the course of the last year or so, we've been seeing a downward trend on those street rates. I think we're looking at our forecast in 2024 to be a little bit under a buck 20 a foot, which when you compare it to pre-pandemic is up, but compared to the last few years, it's down. So I think you almost think of it as a normalization, right? We moved out of kind of a peak cycle, and we're moving more into a more normal trajectory. And the same is true when you look at vacancy rates, right? So we're seeing an upward trend in vacancy rates. We're pushing up into the probably upper 9%. Our forecast for 2024 is 9.8% vacancy. But when you look back into 2019, 2020, they were in that same range. So we're seeing the storage sector normalize. It is going to have construction is still elevated, and so it's in balance. Now, a lot is going to depend on where you are, right? When you look around the country, you have completely different metrics and drivers. You look at these high growth markets like Phoenix, like Tennessee, the Carolinas, Florida, Texas, and so on. And you have this wave of construction that's really putting some pressure on the market. Conversely, you look at some of the markets in California, you look at the upper Midwest, there's very little construction. And so you don't have those same supply and demand drivers in play. So high growth markets are also getting the lion's share of the construction. So your supply and demand are both going up at the same time. And as opposed to kind of the slower growth, the Midwest and the barrier to entry markets on the West Coast, where you have less growth, but you also have less construction. So the equilibrium is moving back towards normal, in my opinion. But I think that looking a little further forward, I think we're going to have even more supply coming online. I think there's going to be an upward trend, and I think that could create some challenges going into 25, 26. But again, a lot's going to depend on that household formation. People are feeling pretty good. We dodge a recession. If we dodge the recession, we go into a stronger growth cycle, and then household formation starts to jump, and then demand for storage climbs.
I mean, so what do we do, right? So as not the newer people coming into our industry as far as building new supply, but the, the incumbents, dare I say, right? What should they do with street rates? I think this may be more of a operational advice kind of question, but more
Yeah.
so than a trends or facts and figures. But what do you think will happen when it comes to independent operators, right? Because I want to ask the same question for the REITs. But with the REITs, we can kind of see in real time what they're doing with street rates. But as independent operators, what do you anticipate will happen here in the next month, quarter, and in the through the first half of this year?
I think it gets really complicated, honestly. And one of the trends that we've been seeing, and this is driven by the REITs, I think you can't really take those two sides independently. You kind of have to mash them together because of the way the REITs are playing ball now. So they're changing the dynamics of the game as we speak. We've seen this happening. They're introducing those teaser rates. They're bringing in very low street rates. We've seen downward pressure on street rates. We're seeing them fall. But what's happening is the REITs, because they have so many more properties and they have a much better information base, they're able to track the existing tenant, the normalization rates, and there are no data sources that are really tracking that. They have a hard time keeping track of that. But if you're extra space or public storage, you have this massive database to work with. So what we're seeing is those street rates are getting dropped, and then the REITs are pushing those rates up on a month-to-month basis with the existing tenants. And so as an independent operator, if you have it managed by Life Storage, Extra Space, or one of the big ones, then you're tapping into that knowledge and that data set that they have. If you're working as a true independent, you have a much harder time tracking with those actual normalization of existing tenant rates. So you can play the game where you drop those rates down, but you're operating a little bit more in the dark in terms of raising rates over time. And it's a little bit more trial and error, and it's a little riskier than, say, one of the big REITs. So rates are going to be the battlefield in 2024. And the independents, quite frankly, are at a little bit of a disadvantage here, and they just don't have the same access to data. So they're going to have to work with their tenants and see where that normalization is on the longer term sustained tenant rates.
So rates are going to be the battlefield. I think that's going to be our mantra this year.
Yeah.
Yeah, and I think we're gonna have to get creative in how we approach that. It's funny, I've had this exact same conversation with a couple of other operators just this week, just that have just reached out to me, and they're like, "What are you seeing in this?" And you've got to get creative, because we don't want to have the same perception. We don't want our customers to have the same perception of us as they do of the big guys, because it's not a good one, and that's not a badge of honor you really want to carry around. And because we're locally owned, we go to church with these people, we see them in the supermarket, so we don't want to be perceived that way. So I think it's going to have to be some creativity and getting that person in the door, some better marketing to actually market that more local. We're a family operated local business right here in your backyard, do business with us kind of thing, which is really appealing. Thankfully, in a lot of smaller towns, that's a really appealing thing. So I think you got to really dig in on those pieces to take advantage of that, because that's something that the REITs can't do. They can play with the rates and they can monkey around with that really successfully, but they can't really go into the schools and make the friends and make those relationships that they need in the community. So that's just my 2 cents.
Well, Eric, in the comments section, I just saw that pop up. Eric made a good point, which is you have to compete where the REITs don't want to play. And he's saying use different size units, mix, and different types of units. And it's a good point, right? You have to play, I call it small ball, right? Small ball as opposed to big ball. So the REITs have to have systemization, right? They want to be able to follow their strategy across the country. They don't want to play around with things. They're not going to go into the smaller markets. They're going to stay in larger markets. Generally speaking, they're going to have a systemized approach. And again, that's where the smaller operators, this is small business versus big business, right? This has always been the way. The small business has to focus on niches. They have to focus in on unique product offerings. They have to add other services. But at the end of the day, I was talking to one investor, one property owner, a small owner, and he said, I went to my customers. I said, look, I'm going to give you a flat rate. You're not going to see it move over the course of the next year. If you go across the street to the big REIT, they're going to bring you in at a low rate. They're going to raise it up, and then you're going to end up paying more. The tenant still went across the street because it cost less at the beginning. They understood, they bought in, but they're like, what? Put their rates lower. I'm going to go over there. I'm not going to be in there that long, right? As everybody thinks, oh, I'm not going to be in storage. I'm only going to be there for a few months. It'll be fine. But they end up staying a lot longer. So it's a game of marketing strategy. It's a game of niche business strategies. And it's going to be a place where you're going to compete locally, whereas the institutions are focusing globally.
Mm-hmm.
Yeah, no, I think I love the niche conversation. I think can be a little bit of a prequel to our conversation next month. We're bringing Stacy Maxwell from Universal Storage Group, and we're going to talk about some of these niche marketing strategies that help this independent operator kind of stand apart from the big guys, kind of like what John's saying, small business versus big business. And I think the battleground is within those niches and carving out what can I be awesome at over here, because you can't be awesome at everything else, right? Or everything.
Right.
So I think that's huge. There's a few questions in the Q&A. Melissa, should we ask some of these? Because I think some of these are
Yeah, they're
specifically,
kind of related,
yeah.
to what we've been talking about. So, let me see here. We saw slightly lower occupancy rates at our facilities in South Florida during the fourth quarter of 2023. Was this a common occurrence in the industry? So was everybody kind of seeing lower occupancy rates in fourth quarter of last year?
I can tell you that the data we're tracking is a rising vacancy, falling occupancy levels nationally. Part of that's construction driven. Part of it is just been a little bit of a slowdown in demand drivers. A little bit of both. Absorption was very low over the course of 2023. The net amount of square footage that was being occupied on a quarter by quarter basis, that net new space in the absolute total space of all storage was very, very small. Not like what we've seen over the last few years at all. I mean, it was barely positive. And so as we added in 2.5% inventory growth nationally, we saw vacancies on the rise.
Okay.
There you go, Errol. So yeah, so I think there's what's the saying? Something about solidarity and sadness, right? So like whatever that saying is, right? I think like it may not remove the heartburn, but it helps me know that, John, you also have heartburn.
Yeah.
Yeah.
It is helpful to know. It's like, okay, I'm not just doing something wrong to create this problem. It's everybody's kind of in the same boat kind of thing. So,
Yeah.
Brenda had a really good question. Will the REITs have as much effect on the rural areas?
So far, they have not been going rural, right? Their model breaks down a little bit, and part of their business strategy is centered on major markets. And now that doesn't mean it won't change, right? So as the Titans continue to consolidate and get bigger and bigger, they continue to have to look at new opportunities in new markets. Now, they may go to smaller tertiary markets, they may go to smaller cities, or they may just try to push more international, right? So storage is a US thing. Even in Canada, it is not nearly as significant as it is in the US or say Mexico. So it may make sense for the REITs to try to go international rather than going into the small cities, but they're going to continue to adapt their business strategies as they build and consolidate major metros across the country.
So one thing I've noticed, and Tommy, I don't know if you've seen this or not, in doing some of the market studies for my clients, I'm seeing, more in that secondary and tertiary markets, we're seeing the REITs ads pop up in areas where they don't even exist. They're 40 miles away, but they are blanketing all of these rural areas with their ads. So if a consumer sees it and they're like, oh, well, this 10 by 10 should only be this price, and that's not what your market's trying to do. So that I think can be a little troublesome on the online ad piece if you're not doing things to make sure that your online presence is up to par and competing well with theirs. What are you seeing on that side, Tommy?
I think that's a killer point, right? I have a client in Medford, Oregon, and there's not an extra space within 50 miles of Medford, Oregon, but or CubeSmart even, and they are now not physically competing, right, John? Like, of course, we know about the 3-5 mile radius. They're not physically competing, but they are very much like Melissa, what you're saying. They're digitally competing, where if I go on Google and I Google storage units near me and I see an ad, I might be peeking at the inventory of a town, the next town over, and then I'm questioning like, whoa, why are these rates 20, 30, 40, 50% higher? And it might impact my willingness to buy from this local operator, right? So in that, yeah, I think there's a digital competition happening for sure. And of course, if you are in an actual physical competition with the REIT as well, you're also dealing with the digital competition with the REIT, right? So we have operators in Orlando, and Stephanie Tharp manages a facility in Orlando, and there's a lot of sadness if you are in Orlando because you have a Public, an Extra, and a CubeSmart literally on the same street as you. So what do you do, right? It can definitely become a battleground. But I think, Brenda, that was a good question about the REIT. So I think my segue for that would be, John, talk to us a little bit about that, right? So right now, the indication is REITs probably will not necessarily go to the tertiary markets, but they will adapt to their business models because that's what they do. They're pretty good at business, right? But are there different parts of the country that you think are going to be more difficult than others beyond just the primary, secondary, tertiary? Are there areas of the country like Arizona's or Tennessee's or Carolina's that might be tougher battles or rougher waters heading into this year?
In terms of competing with REITs, or for the REITs to get into, what's your perspective?
Let's start
Which
with in
direction you
terms of the REITs. Are there pockets of the country that you think the REITs are gonna most likely win out in the sense of like they're gonna have a strong presence in? So let's start with that question.
Yeah, I think again, when I talk to the leaders of the REITs, what I'm hearing from them is they're working on growing their share in major cities. They're looking at growth cities, in particular, basically everything in the southern U.S., kind of the southeast, Texas, Phoenix, and Vegas, even Salt Lake City, Denver. Those are the types of markets where they're trying to build their presence, more so than in the Northeast or California. But again, there have been some big acquisitions, and so we are seeing consolidation. We're going to continue to see that. We're going to continue to see them buy up portfolios when they come available, and even buy out other companies if there's any other sizable blocks that they can get a hold of. So it's definitely going to be a battlefield in major markets, and kind of the top 50 metros across the country is where they're going to be most concentrated, leaning towards more movement into the southern U.S. And quite frankly, they're looking at each other more than they're looking at the little guys, right? Your Public Storage and your Extra Space are watching each other, and they're trying to beat each other more than they're worried about trampling small independents, which is really incidental damage in their mind.
Yeah, we're just collateral damage over here.
Yeah.
Us small potatoes.
They
Well,
don't even notice when they step on us.
yeah. Well, on the consolidation piece, right? Talk to us about that. So the obviously, well, maybe not obvious, but to the audience, I mean, the biggest acquisition in history of self storage was happened last year, right? Extra Space buying up Life Storage, and I believe, and John, correct me if I'm wrong, I think the square footage now is in favor of Extra Space over Public with that acquisition, right? So how does something like Public's been the number one operator for 30, 40, 50, 100 years? Not quite that long, but they've been the top operator for forever,
Yeah.
for as long as our existence, anyways. What is that? Does that tip them off? Does that make them want to reclaim number one? And is there any validity into that?
Well, I haven't met everybody at Public Storage. I've met a few of the executives over there, and they are very competitive. They're really serious about being a dominant force in the industry. And I don't, they took the first run at Life Storage, right? It wasn't Extra Space. Public Storage went in and said, "All right, you're with us. We're gonna buy you out. What does it take? Come on, let's make a deal." And I think that there was a little bit of a culture issue. I think there were some issues, and Life pushed back and went out and ended up partnering with Extra Space, which appears to have been a pretty good fit. But again, Public Storage isn't going to be left standing out there. They're going to continue to grow. They'll develop. They'll buy up anything that is developed, and they're going to continue to expand. They'll look at portfolios as they come on the market, and they're going to look at rebranding. So pulling other brands in and rebranding them to Public Storage. So Public Storage, yeah, in terms of square footage, they're number 2 right now. Don't bank on that. Extra Space is going to go through a digestion process with all of these new facilities. They're looking at, do we rebrand? Do we keep some of them as Life Storage? How are we going to do this as we go forward? And so while they're dealing with that, incorporating such a big acquisition, I think you're going to see Public Storage out there on the hunt throughout the year.
Okay, so Tom had an interesting question that's around the consolidation piece. With the consolidation of the industry continuing, what do you expect the top 10 owners to control on a percentage basis within the, say, next 5 years? Look into that magic ball. I want to hear
that's a hard question to answer. I honestly, I don't know what they control now. All I can say is it's going to be more. Really honestly, this is looking at it from a different perspective. You look at the industry as a whole, okay? It was a cottage industry, not even that long ago. You go back 20 years and storage was a very niche property type. It was really a land bank. You were going out on the fringe, on the edge of a city. You were banking land, and you put storage on it to cover your costs and maybe make a little bit of money. That's really what the foundation of the industry. It was very entrepreneurial. It was, you had some larger storage facilities and companies out there. Public Storage is one of them, and they were growing, but it wasn't mature. And what we're going through now is a maturation process, both in terms of the consolidation by the major industry players, but also in terms of the investment into storage that's taking place. So even 5-10 years ago, we were not looking at major investor groups, institutional capital going into storage, right? They were really focused on office buildings. They were looking at industrial. They moved into apartments, 10 years ago or 15 years ago, they were really starting to dig into the apartment side of things. They were not in storage. Now, you go to any institutional investor, you go to a BlackRock or a Clarion or some of these other ones, and storage is part of the conversation, right? They're viewing it as counter-cyclical. They're viewing it as something to offset some of their losses in the office category. They're looking at portfolio balancing and management, and they're integrating storage as part of that. So storage is going through a maturation process, and part of that's going to be consolidation by the major brands. Part of that is going to be more capital coming in and acquiring these properties from different channels. And I think that that's going to be good for the investors over the long term in terms of the valuation of these assets. But it's really hard to say, how much of the, what is the Big Ten going to control? But it is going to continue to increase.
Awesome. Okay,
Yeah.
Tommy, I don't even know where we are on our list.
No, so I think now that we kind of have a picture of where we are, right? I think, Melissa, let's talk about how should we approach 2024 now that we know the consolidation piece, we know that, occupancy is down, vacancy is up. We understand some of the headwinds, we understand a little bit of the tailwinds, maybe some hopeful tailwinds with more single family housing movement, right? We understand all these pieces. So let's talk about what we should do about this information in 2024. So I think there's a few good questions and
Yeah,
topics there.
there's actually some questions that I think will probably be answered that's come up in the Q&A about this. So talk to us about pricing and discounts, and maybe even in that conversation, the unit types and mix that are going to be important this year that we need to look at changes, or how should operators be kind of approaching their decisions in those?
Okay, so I'm more of a macro person looking at the bigger picture. So getting into unit size and composition of units really isn't going to be my strongest suit. There's better people to listen to than me out there for that. But what I can say is that, again, what we were talking about with rates earlier is that's going to be challenging, right? So you got to monitor the market rates, but you also have to figure out what your normalized rate is for your tenants. That's gonna be a big challenge. You need to really monitor construction. Okay, so when I'm looking forward at the construction pipeline, one of the things I use as a forward indicator is a measurement of construction spending on storage. And we inflation adjust that and look at the pipeline of capital flowing into the construction of storage, and that's rising, and it's actually rising very rapidly. It's higher in 2023. At the end of 2023, the amount of capital going into storage construction is actually about 20% higher than we saw in 2018, which was the peak of the last development cycle. So I'm a little concerned about that. Now, I talked to a lot of the larger investors, and they're saying, yeah, but not all of that's getting built. They're getting it started, but it's getting delayed. There's these rate challenges, these are occupancy challenges, and they're slowing this pipeline down. And I say, yeah, absolutely, but it's still sitting out there, right? It's still waiting. It's already getting positioned to be developed. So it's definitely a caution flag. Now, as an operator, again, looking into 2024, it's a roll up your sleeves year. This is what I'm saying in terms of pretty much every property type, certainly in office, apartments, and industrial. It is a roll up the sleeves kind of year where you sit down, you look at the local competitive landscape, and you really have to nail down your rates. You have to sharpen up your marketing strategies, your advertising, your online presence, and really get dialed in to compete this year, because it's going to get a little tougher. There's new units, there's new supply coming online, there's people going through lease up, there's a lot of new competition with the REITs and the institutional investors. And so it's a roll up the sleeves kind of year. When I'm talking to the owners and the investors themselves, there's a lot of the old timers, the ones who've been in this business a long time, who are starting to move out of the sector. They're saying, you know what, this is great. I've made tons of money. This has been a fantastic investment, but I don't want to play anymore. It's getting more and more complicated, and I just don't want to. I don't want to take my game to the next level. I'm going to cash out. I'm going to cash out some of my chips or all of my chips, and I'm going to move on. And that's creating opportunities for people who are still growing in the space. I talked to a lot of syndicators who are expanding, adding more facilities. I talked to a lot of private investors that are getting in and being aggressive in their growth. So it's going to be an interesting dynamic year. It is a year where operations matter. How you manage your facility, how you are interacting with your customers matters. And this is a maturation process. It's just becoming more sophisticated, if you will.
I love it. I wrote down all of what you just said. No, just the whole roll up your sleeves, and the marketing matters, and being ready to compete, and the operations matter, and how you treat the customers matter. All of those things, that's what our focus needs to be on. And while we can't ignore what the REITs are doing down the street, if we are focusing on making our business the best that it can possibly be and getting back to those basics and those foundations, I think we're going to be okay. If you get lost in trying to chase the REITs and all of their price changes and all the things that they keep throwing at you, I think you might end up getting lost in it. So I think we've got to focus on what we can actually control. So
Yeah,
You
I
know,
love that.
I was just thinking, let me add on to that. If you think about this, think of the restaurant business. Okay. There are national chain restaurants. They do a fantastic job. They're very consistent. They have a very systematic approach to doing business. They have a formulaic recipe, and they run that play over and over and over again. But there are also very, very exceptional local, independently owned restaurants that crush it. Now, they don't have a footprint in every city, and their model may not expand all over the country, but they can do very, very well in a local market. I think you have to take a model like that and consider, what do I do with my menu? How do I operate my restaurant? How do I manage my restaurant differently than that chain restaurant that is all of those different chains that are all around me? And how do I compete for share of wallet in this space? And I think that that's similar to what the local storage operators should be thinking about, is what am I going to do differently to position my asset away from those national chains and make it more, cater it more to my local demand drivers.
love it.
That's so huge.
Awesome. It's very encouraging because there is stuff we can do as smaller
Yeah.
operators.
Roll up your sleeves. I
Yeah.
mean, I think that's mantra number 2 today.
Yeah. All right. I think we're on to, or do we want to get some of these questions out of the way?
I mean, these are some killer questions. Let's knock out
Yeah.
a few more of these questions.
Let's-
So here, oh, actually, this is a good one. This one, Roy asked this one earlier in the episode. So John, like, as an independent operator, where do I get this data? Right? Like, is there a place? Like, talk to us about where, as an independent operator, to doing my own research. I don't have a whole, firm that can just give me a bunch of data. Where can I go fetch, even, whether it's free or paid data? Where can I get this data for self-storage?
Sure. So there's a lot of answers there, right? So let me start with the types of things that we subscribe to, right? So economic data, right? We're subscribing to Moody's, but Moody's is an aggregator, right? There's the Census Bureau data is in there. There's Federal Reserve, the St. Louis Fed, the Fred data. There's just a bunch of information out there. It's a pain to collect. That's why we pay Moody's, is to basically take all that data, consolidate it, and make it something that's digitized, then we can get it easily. Moody's is not inexpensive. That's not where I would tell most smaller operators to go. But I'm just pointing out that's where we're pulling it. In terms of, so that's your economic data and a lot of your demographic data. You also can look at, for the property data, you got Radius and you have Yardi. Those are the big two. Both have very good information. They overlap to a large extent, but they do have unique nuances. And if you're looking for storage data, I would go look at each of them and make a decision based on what your specific needs are. Then Probably the least expensive, easiest to access, consolidated source is actually our company, Marcus and Millichap. We have available on our website a variety of reports focusing on economics and storage trends. There's also information on 10 other property types, right? Apartments, retail, office, industrial, everything. But we do have storage data and information. We generally have quarterly reports where we're going in and highlighting some of the most important trends that we see. And we will also be releasing our 2024 investment forecast for storage. That will probably come out in mid-March for our release date on that product. And that will be available on the Marcus Millichap website. All you need to do is register and you'll get access to our research. So if you want to get to the source data, you want to get down and, really get into the nitty gritty of it. If you have, a research team at your company that's drilling into this stuff, yeah, you can go to the source data. It's all over the place. If you just want the quick and dirty, what's the main perspective from Marcus Millichap, we make that available.
Awesome.
Awesome. Love that.
Okay, there's another question here. This one's kind of broad, but I feel like it's something that we've talked about for the last 2 or 3 years, just until we're all sick of it. Remote management versus manned facilities. And like, where do you see that going in 24? As we just finished talking about, let's get back to the foundational pieces of, our operations and tightening up our marketing and customer service. How does that play out with the remote versus the manned facility?
Boy, they each have strengths.
Mm-hmm.
And they both have weaknesses, right? So remote, if it's all digital, right? If I can control my unit, access everything, I never have to talk to anyone, especially with younger generations, with millennials and Gen Z. If they can do it on their phone, they're happier. And if they can have 24-hour access and they can do it all electronically, they're generally happier. But when there's a problem, they want to talk to someone, right? So you have to have some level of customer support there with real people. Now, baby boomers lean the other direction, right? They like to talk to people. They want to go in and be able to, they don't want to try to figure out some app. They don't want to go in and figure that. They want to go in and say, hey, I need to rent a unit here. Give it, let's go in and we'll walk out and you can show me which one's available. They're much more interactive that way. It's old school. So you kind of have to understand who is your customer, right? Every marketing strategy should be based on who is my customer, what are their wants and needs, and how do I solve those, right? What want or need can I support or service that I'm in a unique position to provide? You have to understand the landscape of your competition. What are they doing? How are they operating? But you need to understand that customer base first and position accordingly. So both have advantages. If cost is not an issue, maybe some sort of a hybrid, right? You want to have all the electronic services available, but you also want somebody there 24, not 24/7, but during regular business hours to provide that customer service and that support. If you have to pick one or the other, it's going to really depend on who your customer is.
Love it. All right, Tommy, did you have
Yeah.
another one?
I did. Let me scroll down to find it.
These are great questions.
Yeah, these are all fantastic. So Robert asked one. Here we go. This is a good one. So last year, John, you talked about generations, right? And you just mentioned the different preferences from a Gen X or a Gen Z to a baby boomer, right? And their growing impact. And specifically last year, you talked about how millennials and Gen Z people have started to become a bigger portion, right? A proportion of
Yeah.
the of storage customers, right? Any updated opinions on this? Any projections now that we're a year later? Any new news around the age demographics of self-storage consumers?
Okay, so I got a curveball thrown at me a few weeks ago, or actually a couple months ago, so I look at these demographics all the time, And this is Census Bureau data. And all of a sudden my graph changed. And I saw that there is an echo of the millennials. So the millennials are basically in their 30s, early 40s now, 72.5 million of them. They're kind of in that sweet spot of buying their first home and all of that stuff. But behind that generation, there was really kind of a drop off in population going into the Gen Z. Now, for whatever reason, the Census Bureau updated their data, and now there's an echo behind the millennials that are 21, 22 years old, a little bubble of young adults there, which is great for real estate, right? That's great for apartment demand. That's great, future apartment demand, storage, retail sales, everything else. That's good news. Why the Census Bureau just found these people, I don't know, because those numbers shouldn't change that much. But hey, surprise, it's good news. So in terms of the use of storage, the trend is younger people use it more frequently. They are visiting those sites more often per month, and they over-index in terms of the amount of storage, share of storage that they're filling relative to the size of or proportion of the population. So millennials over-index. I think Gen Z is over-indexing a little bit, but a lot of Gen Z is still young, under 18, and they're not going to go out and rent a storage unit. At least they don't usually have a credit card to do that. But I think Gen Z is going to over-index, and I think they're going to be a higher use case model as well. I think that that's part of what's driving the outlook of the sector. I think that we have good demographics looking forward, and I think that user base is a solid user base, and will be, again, this is kind of where that digitization comes into play. If you're targeting that audience, having the electronic systems, the access, the apps, 24-hour access, those are all going to be positives because they are going to be using it actively, as opposed to older generations, the boomers, the greatest generation who's in their 70s now, 70s, 80s. They're not going to be going into those facilities very often, right? If I'm Phoenix, if I'm in a part of town that has a heavy retirement community, I'm leaning towards that more customer service, hands-on approach with the older generations. But there are, if I'm in, middle of Scottsdale, I may be looking at a younger generation and catering more to that younger audience. So again, know your customers.
Love that. Robert, great question, man.
Yeah.
So let's look forward a little bit here. So I think we asked you similar questions last year, and I'd be interested to go back and see if your predictions ended up coming true.
How'd they do? How'd we do
but
here, Tommy?
but let's talk about these trends that you've talked about, right? So which of these trends, or any that we haven't touched on, right? Which of these trends should we be most concerned about in this coming year?
Yeah, I'm watching construction. That's my construction, and and what happens with the street rates versus the longer term rates. Those are the two big moving variables that are going to impact the operator at a street level and really influence every property on a property by property, and therefore the entire industry as a whole will be impacted by those two dimensions in 2024 and into 2025. Those are going to be the big items.
Okay. So to push that out a little bit further, what trends do you expect to emerge in the next 5 years or maybe even 10 years?
That is a great question.
Did you put your crystal ball away too soon?
Well, I'm not thinking that far ahead. Come on. So let me think about this for a second. So actually, let's walk through this together, right? We have industry consolidation versus the smaller niche players. You're going to have the major players going into the major markets. You're going to have the niche players going into the smaller markets, and that's going to probably shape the industry as a whole, and how it progresses. But again, if you have a model, a high touch customer base in a major city, and you are using a 20 a service based model, you may be able to outperform the major players because they're going to be more focused on automation, right? When you get bigger, automation becomes more and more important. And so that's where the smaller independents are going to be able to outcompete. If you have great management and great people, you're going to be able to outcompete in that type of an audience. I think that the construction continues to rise. I think that there is continued maturation of the sector. I think there's going to be more standardization. I think that the internet marketing, we've seen that become more and more important over the last 5 years or so, and it's going to become paramount, right? Just a few years ago, it was very difficult to rent a storage unit online. Today, that is accepted as a standard. That is the way it's done. So it's really going to interweave that technology as we go forward. So, Melissa, I don't know if I answered your question, but
I think you kind of did. Yeah.
You get a little insight into the inner workings of my brain, if nothing else. There.
No, I've taken more notes today. This has been really, really great. And I just go back to it. It's everyone on this call should be encouraged and not, hopefully we've recovered from the doom and gloom. And yeah, there's still some things that could happen. Anything can happen, sky can fall tomorrow, but there are things that we can control in our daily operations and how we choose to do business that really does impact our bottom line, no matter who you're competing against. And that's encouraging. I know for the smaller operators that I work with on a daily basis. So I've loved everything that you've had to say today.
Well, I think the outlook is continuing to improve, and that is promising for everybody, regardless of your business. But again, I don't think the smaller businesses are going to be outcompeted. I think they just have to focus on their space.
Yeah.
Right.
Right.
Okay.
Well, so John, I think you've already answered our question of the week, but I'll flash it on the screen here in case you have anything else you'd add to it. But our question of the week is, what's one trend, right? You gave us two, construction costs and the street rates performance. Anything you'd add to that? So what's one trend that you think will affect our industry the most in 2024? And I think impact or effect here can be a negative or a positive. What's one force that you think we should be excited about in 2024?
Well, you know what? I've talked a lot about what's happening with rents. And I think that's important. I think construction, I think roll up the sleeves. Those are all big things. Let me give you the one thing that I'm monitoring that still poses could go very well or it could go terrible. And that is what the Federal Reserve does with interest rates. Right? We haven't talked about that much. That's a big thing. Now, the consensus is that they're going to pull down the overnight rate by 100 basis points or so, 125, 150, but about 100 basis point reduction in interest rates over the course of the year. That's going to change the nature of capital flows. That's going to change the nature of mortgages on houses. That's going to change how the economy grows. If they don't drop the rates, if they keep them too high for too long, right? You hear higher for longer. If they keep them too high for too long, they could squelch the recovery. They could miss the soft landing. They could hit the recession. We could have the quote unquote hard landing. But again, in that webcast we had with Mark Zandi, it was one of the things that he identified, and he has been identifying, same with capital economics, as one of the biggest variables will be Federal Reserve rate policy in 2024. And so setting aside all those operational things that we were talking about earlier, That's the one other thing in my mind that could really shape the outlook for pretty much all of real estate.
Wow. Let's keep an eye on the Fed. Wow. So John, before we get your contact info, because I know the people want to reach out to you, there are two or three other quick Q&As that I'd love to get to. So one is more just in addition to some of the market trends and those other things, where else, or unless you have it in your brain, where else would I get information on unit mix, like climate control versus non-climate, or do I need to build more RV parking? Like, as an operator, as a potential investor, where can I go find that sort of data? Where do you recommend?
So, Self-Storage Almanac, great product, great resource, lots of insights in there. And even if they don't have a brand new one out, get one from last year. There's just a fantastic resource. In fact, get all the ones from the past if you can. We had a collection here in our office that we keep. That's one source. Again, I think Yardi and Radius both have information on the specific unit mixes and how they're performing, climate control versus non-climate control, and so on. So those are fantastic resources. Really good companies that I've been doing business with for a very long time. So those are the places for storage specific data. And beyond that, you got some consultants out there who are right up into their elbows in this stuff and really know what's going on. And so there are those resources as well.
Love that. I put the link in they'll be in the show notes as well. A link to pre-order the 2024 edition. But like John said, go ahead and buy 2023's data as well, and any copy that you can get your hands on. Another quick one from Kelly. What are your thoughts on the future AI? We didn't get too high tech in this conversation, but do you think AI will have its place in our industry this year?
This year, probably not. Not in 24. But eventually, yes. And what that will be, I don't know. I mean, literally, AI is very difficult for me to, I guess I'm just a little older, but it's very difficult for me to really understand how that's going to play in business. But I will say, so for example, I have a data analyst who runs a lot of data and normalizes it, and he uses AI to help him write programming for data analytics. And we have researchers who are writing reports on local markets. They'll use AI to structure some of the language of what they're writing, even the guy I have here helping me run all of my video production uses it for talking points when we promote our videos. So it's integrating into our business in unique and different ways. How it affects storage, I don't know yet. It's going to be trial and error at first, and people are going to tinker with it, and God, I don't know. It could get interesting unless it goes Skynet on us, and then we're in trouble.
Hopefully you were nice to the AI bot when you were asking it questions. To that point, so there's been three different ways that I think AI could impact us in self-storage specifically. I think one, John, you touch on like data crunching. Right.
Yeah.
So the firms or the more high tech amongst us, right, are going to be able to crunch more data faster, right? Instead of just scrubbing through spreadsheets, scrubbing through almanac data, eventually, very soon, we're going to be able to dump that into a thing and it's going to give us the analysis for it. I think that's going to accelerate a lot of decision making, and some may be trial and error, like you mentioned, right? So I think that's going to be interesting. The second thing is I've seen this happen already is organizations scraping internet data. Of course,
Yeah.
larger firms have been able to do this, right? Extra Space absolutely scrapes internet data. But with AI being more accessible to the normal people amongst us, now you can also scrape your competitor data in a way that it might be useful, right? And I think the third way that I think self-storage will use AI is customer service driven, right? Instead of having to talk to a human for everything that you need, I think more businesses will offer AI support. Now, again, trial and error, and probably with more error than success at the beginning. But I think we're going to see operators try that. And of course, there's companies in our industry already like Swivel, who's pushing the kind of the boundaries of that. But I think those are three of the more obvious ways. But I think I'm with you, John. I don't think 2024 will be AI's year in our industry. We're a little slow to adapt anyways.
We are very
uh,
slow to adapt.
uh, but I think, in the conversations that I'm having with people, all three of the things that I've mentioned are things that are being done today,
Yeah.
right? So I think it'd just be interesting to see the adoption of those technologies. But I think the data crunching piece, in John's vertical, AI is going to really blow the lid off of that and make that kind of analysis a lot more feasible and faster, which is kind
Mhm.
of fun and exciting. So John can come speak more on it.
Well,
Exactly.
honestly, I'm old school. I still like people analyzing the data. I got a team of 20 analysts here, and they're really, really smart. And the sophistication of AI, at least I haven't seen it get to the point where it can adapt the way a human can.
No.
And so that's why I don't use models, right? I mean, I use basic models to get a general trend, but we don't use the models when it gets down to the granular level, because what's happening in San Francisco is very different from Dallas and very different from Chattanooga or South Carolina or New York or Chicago or Phoenix. Each market has very unique nuances. And once you get out into some of the smaller markets, it becomes even more complex. So the ability to normalize is very hard. AI has a lot of hurdles to get over before it's going to be able to really understand the nuances of the individual metros and all of the forces in play, which we can't even calculate. We don't even have data on, but just simply knowing the market, driving around town. I did a big presentation in Portland, Oregon, a couple weeks ago, and literally I got off the airplane, I got in a rental car, and I drove the city of Portland for 3 hours, looking at street corner after street corner to understand what's happening in that city today before I
Wow.
went and got on stage.
That's incredible.
And AI is just not going to do that.
No.
Not yet.
No, not yet anyways. No, and I think you're right. I think that's our we're a tech company. We develop tech things, right? And I think that's our general take right now on AI as it relates to self-storage technologies. Like, yeah, I think there are certain things that humans can still do better. And I talked to a group of students recently who, if you're in high school right now, AI is incredible because it
Yeah.
can write a paper for you, right? But I think what's being taught is, and I think this is not self-storage related at all, but I think professors and teachers and our education system, they're going to have to adapt very quickly,
Yeah.
right? Because this AI thing came at us in 2022 and it is not stopping anytime soon, right? And I
No.
think the teachers, I feel for them, I love them, and I feel for them, but our education system's going to have to adapt. And I think what's kind of exciting about that is now students don't, yes, learning how to write a paper is important, but it's more so now what's the nuance that makes it really special, right? And I think much like you said, right? I think that nuance that your team of analysts, they have so much nuance that they can give so much what's the word I'm looking for, Melissa? Like so much magic sauce, special sauce
It's
to,
human.
yeah,
It's
it's you.
just it's just human. It's because we understand, like you said, John, having to drive around Seattle for 3 hours to actually see with your own eyes what's going on in that community, that no AI is ever going to be able to accomplish, because we can actually understand from a human level what the humans are doing. And I think that's something, there's always, I think AI, if it's used responsibly, will be used to help us do our jobs maybe more efficiently. I like the uses of, speaking of how it's being used in self-storage, it's more along the lines of security, like the things they're doing with the cameras now,
Yeah.
and keeping an eye on your facility in a pretty cool way, because we can't stay awake 24/7. And so it's another set of eyes, kind
Yeah.
of. But so I really like that it's being used in those ways. But I think there is a danger for people to use just this influx of data that you can get from AI. If you don't really know how to interpret it, it's just another huge pile of data.
It's all nuance. It's all in the niche,
Yeah.
and I think that's the part that's going to be very exciting, because now if our education system figures it out, then we can actually teach children nuance,
Hmm.
right? And then we can really lean in and obsess about that piece of it. And I think not just our children, but our self-storage professionals, right? We can actually lean into the nuance. And I think, honestly, John, that's why you are such a sought-after speaker. And again, thank you for coming and speaking to our Gabfocus audience. You not only understand the nuance, but you are great at communicating the nuance. And
Hey.
Melissa said it multiple times. She's been taking notes out the yin yang, and I think I think it shows, right? But man, thank you for coming out today and answering all of these questions, and dropping some really incredible nuggets for this year. So how do the people get a hold of you or Marcus and Millichap if they would like to learn more or get more advice from you?
Sure. So, of course, you just go to the Marcus Millichap website. I think you have a contact channel through there if you want to reach out to me, or research in general through the Marcus Millichap website. You can also follow me on LinkedIn. Every week, I'm producing a new video about what I think is going to be something significant in the economy or the marketplace that's affecting commercial real estate in some way, shape, or form. So following me on LinkedIn is another great way to just stay in tune. And we'll also announce all of our major reports through LinkedIn as a company, Marcus Millichap. So couple ways to chase me around there, but I'm always looking for opportunities to connect with investors and provide whatever insights I can to help them make decisions.
You're incredible. Well, you mentioned you were in Portland recently. Where's your next in-person event?
National Multi-Housing Conference in San Diego next week. I'll be there Monday through Wednesday for that event, and I can't even remember where I'm going after that. So one step at a time.
one, one flight at a time. Well, John,
That's
thank you
great.
for coming out. Melissa, what a fun episode.
Yeah, this was great.
This has
Thank you so
been.
much, John.
I did see a
A
question in the
pleasure.
comment section earlier about will we send a recording? Absolutely. So this episode and every past episode's available on all these channels, storagepug.com/resources. It's available wherever you listen to your podcast as well. I believe I saw Josh will get this published later today on the podcast. So up next month, we are bringing on Stacy Maxwell from Universal Storage Group. We're going to talk about grassroots marketing. We're going to talk about rolling up our sleeves. We're going to talk about all the things that John talked about and how we can actually apply that in 2024. And we're going to do it on Leap Day. It comes around once every 4 years, and we're going to make it happen. So, y'all, thank you so much for coming out. John, I won't see you in San Diego. It would be nice to, but looking forward to see you one of the future, your next stop later this year.
Fantastic. Thanks a lot, Tommy. Melissa, good fun chatting with you guys. That's what it is. It's just a conversation among friends.
Absolutely. Thank you again.